SpotGamma.com.
What's up, everyone? Thanks for joining. I know we have a number of guys from our chat in here, so I'll pass it to Sam just to say a couple words about Zeal.
So, we started Zeal, with the idea that, we could teach someone a process, based on, technical flows and order flow, that we could teach someone a process with proper risk management that they would be able to become a consistent trader. And we're about a year and a half into Zeal now, and I gotta say, I'm pretty pleased with the results. So without further ado, here's Brent from SpotGamma, guys.
Thanks, Sam. Appreciate you guys taking the time to talk to us today. I'm looking forward to this chat with Sam. What we do is we analyze the options market and we try to forecast how the equity market will move. So that's support and resistance lines as well as volatility. Everything that we do is driven by our view of the options market and how that may impact the underlying equities. So it's been a fascinating couple of years for us. I think we went through this idea, in late 2019, early 2020, that we're trying to convince people that the options market could move the equity market or the S&P 500, and that took a lot of convincing. And then as we moved into meme mania, it sort of became this piece of universal knowledge that suddenly everyone understood. So Sam, today, we had a couple earlier conversations, and one of the things that we're watching right now is we watch the size of the put options complex, basically. How large are the puts that are in the market? And the idea is that when you have times of high volatility like we do now, there's obviously a lot of reasons for people to want to own downside hedges, whether it be single stocks or in the indices as a whole. And the opening and closing of those puts is what we believe drives volatility. And that's because essentially, if traders are buying put options, right, dealers and market makers are selling them those put options. That makes them short puts. And the way that they would hedge is to short futures or short stock as the market goes down. And then if the market comes back up, they need to buy futures back, right? And that is what expands volatility. That's essentially called negative gamma trading. And so what we've seen is there was very large put positions in March. Into the Fed in March OPEX, all of those put positions were closed. Massive puts were closed. That drove a 10% rally in the market. And then over the last few weeks, we've been slowly rebuilding that put position. It's not been as big as obviously March was, but now we're 2 or 3 days here now before another fairly large options expiration. That's on Thursday the 14th. We obviously have Good Friday. And we see about 20 or 30% of the total put position in the S&P 500 as set to expire. And so right now we're trying to balance out this idea that Sam and I were just talking, like, everybody is bearish right now, right? It's kind of this universal belief. It's a lot of volatility in the treasury market and in the credit markets. And it's a little bit of path dependency, right? Right now we have these puts that are expiring. We think in general, when puts expire, they decay, right? And as they decay and as they lose value, market makers can buy back some of their short hedges, and that can help boost the market a little bit. And then we're going to run into this options expiration. It's a long holiday weekend on Thursday. And in our view, this clears out room for another leg lower into the end of the month. And I think that's something that Sam was mentioning. Correct me if I'm wrong there, but
yeah. Well, it all started for me actually back on April 4th. I noticed a couple things starting to happen. Like you had said, we had a ton of negative gamma, in the SPX. Dealers were positioned pretty short gamma, and after the Fed and nothing materialized, we had that large compression in VIX, which led to those Vanna and Charm flows and the buying back of futures that led that market on, what was that, almost a week and a half, 2 week run up. And then we started to pull back a little bit, and I noticed that the SPX, we hadn't built a material amount back in negative gamma, but in the spiders, we had a little bit more negative gamma than in the SPX. And I was looking at a couple things I look at, and the skew index was sitting right under that 146 handle, and that also kind of coincided with the low in the fixed income volatility in the move index. And I believe the VIX was trading just under the 20 handle at that point. And I was kind of just looking at the whole dynamics of the market and figured, I felt like, vol kind of seemed to be a little cheap, because that was at the same time that we had realized vol actually at a higher level than implied volatilities. So that to me was kind of a little red flag that, hey, you know what, maybe the market's under hedged right now. Everyone got a little too cleared out of their positions, the market rallied, everyone's a little more comfortable now. And I figured, you know what, maybe that would be a good time to actually get some exposure to the short side, because in my personal opinion, I thought, vol was pretty cheap. So there'd be, that optionality on the put side that vol could expand a little bit more if we were to get that push down. And sure enough, that's kind of how it played out the past couple of days. Just curious, your take on that, whether you pay any attention to the skew index, like we talked about earlier, the fixed income volatility and that stuff.
Yeah, one of the, I think, things that we've been highlighting is the dispersion or the divergence, I guess I call it, between the MOVE index, which is the bond VIX, as you mentioned, and the VIX itself. And you have the MOVE index, which is at a 2020 highs, and we have the VIX, which is right around 23, 22, which is fairly near 2022 lows. So, you mentioned the skew index, which looks at tail risk and some of these other metrics. And I think a lot of people have in their mind that volatility in general, the lower bound for volatility is still back in the VIX of 12 to 15 days, right? And that's ultimately maybe where we'll get back. And this is just a different market right now, right? It functions differently. The Fed put now, a lot of people say, is now a
Fed call,
right? That's the saying. Friend Imran talked about that earlier today. And so the point here is that the way that you need to operate sometimes, I think, as a trader in this environment is to just identify when something is cheap or relatively cheap, right? And in some ways that can include volatility, right? It's very hard to navigate this market. I think in general, we're saying, like, over the last 2 years, look, you just buy every dip and the market kind of mean reverts. And that was just sort of the way that it worked for everybody. And it was a popular trade and it worked well. And this is arguably a little bit different. And I was talking to a good trader friend of mine, and we were saying, like, I'm not 100% sure what this market is going to do tomorrow, right? But vol here is just cheap, meaning implied volatility is just cheap. And that in and of itself could be a good reason to buy puts, right? Because a lot of people are going to have a hard time forecasting this market out 3-6 months. I mean, you listen to a lot of the macro guys and in the dislocation in commodities and in treasuries and all these different markets, right? And the saying goes, right, buy stuff when it's cheap and sell when it gets expensive. And to your point here, you got the skew came down. The market is well above where we were when the Russia sort of issues started. The Russian invasion started on February 24th. We have higher inflation rates now, more Fed uncertainty, all those other things, and implied volatility, i.e., like the skew index, is just an asset class, right? And sometimes the reason you buy put is just because it's cheap. Same thing with calls, right? Sometimes you can buy calls just because they're cheap, and I'm playing these position imbalances. So I think that's very perceptive. I mean, we were looking at for many of you who are familiar with, obviously, the VIX term structure, right? There's a sharp contango to that right now, and I think this affects skew because a lot of the flows are generated by traders that like to sell very short dated options, right? Like to sell tomorrow's expiration or today's expiration in the S&P 500, and that, particularly over the last couple of years, is a very popular way to make money, obviously. And you can have a view out in a day or two that it's a fairly safe, right, quote unquote safe, to sell that very short dated volatility because what's really going to happen in the next day or two. I think I have a pretty good view of what's happening. And I think there is a longer dated bid for volatility, like a bid for puts, right? That is rolling kind of 30 days out or 6 months out in time, because it's sort of a responsible thing to do. You don't know what the tail risk is in these days. And so you get this sharp, what's called contango in the market, where short dated volatility continues to get sold and longer dated volatility has a little bit of a bid. And eventually what happens is when something does get a little bit scary, people do get nervous, suddenly that short dated volatility, that volatility that's like 5-10 days out, suddenly catches a really big bid. And we get these jumps lower in the market, right? Get these gaps. It's like a new feature of the market, this jump risk idea, basically.
And it's interesting too, because I've noticed too over the past, I don't know, maybe the past couple months too, every time that term structure does get into, a deeper backwardation stage, it's almost always at some point they come in and they just step on vol. And we do get that reflexive, I guess we'll call it the Vanna bid in the market. Right. You usually do find a short-term bottom and just bounce from there. And I think for a lot of newer traders that pretty much started in after the COVID crash, they that kind of still is stuck in their head. And it'd be nice for them to understand, you know, the inner workings of why these bounces happen, and not just think that, okay, that was a crash. We buy every dip and it's going to go up from here. So that's something we've been trying to, you know, really push on the guys too, is understanding, you know, I guess we'll call it the reflexivity of the market and why this happens. And you know what, that sometimes that's just, it's not material buying that's pushing the market higher. It's just the nature of flow of these hedging flows coming in from these Delta One desks.
Yeah, that's a great point. So we talk about in our subscriber notes that there's like 3 phases of analysis now, right? There's fundamental analysis and technical analysis. Everyone knows that. And arguably what we focus on is positional analysis, right? How are dealers and market makers and counterparties positioned? Because when those positions shift to sort of a maximum bound, right, then things can happen. And that's sort of how we think it works in the options market, where if you think about late March, people they added puts in January when it came clear that the Fed was going to start raising rates, and traders knew, look, this is going to be a tough market here because we don't know what the Fed is going to do. We got to hedge out till the March FOMC meeting. And that's why we think so a lot of people bought puts there. And that's why we think when the Russia situation kicked off, the market didn't move that much down lower, right? It sort of like it dropped, you know, a % or 2, but then it sort of stuck there, and it was this volatile sort of whipping back and forth over the next few weeks. And a big reason we think that it didn't make a new lower bound or crash farther is because we had this idea of max puts in place. Now we measure that at SpotGamma with this tool called the Delta Tilt, and all it basically does is it looks at the total deltas. So how big is the put position in the market for the S&P 500? We compare that to how big the call position is. And in March, we hit a put position that was as big as it's been at any point, basically going back to 2018. So almost as big as March of 2020 and almost as big as December of 2018, which were, you know, really kind of tumultuous periods in the market. And this is a long-winded way of getting back around to what Sam was sort of bringing up. But if you think about how market makers are positioned, you say, okay, look, they're the ones that are supplying the market with these put options, right? All the traders, if we're all here buying puts from dealers are short puts sort of in and around the money, right? But as you all know, if you're short a lot of puts and the market crashes, you're going to lose all of your funds, right? Your account's going to get closed. You're going to get a margin call. And it's the same thing with market makers, right? They can hedge small moves by shorting futures. But if you get a VIX 100 tomorrow or a limit down in the market, suddenly the dealers are exposed to convexity, right? And you don't want to be short a put when the VIX goes to 100. So what do? The dealers own tail risk. They own those options that are 30% of the money, you know, those longer dated things where essentially it's a Vega hedge, right? If the market goes really crazy and we get convexity, they're actually hedged. And so my, again, long-winded point here is that when we get that tail move down, when we get the sort of the bump down from some of these geopolitical events, those tail risk or those Vega hedges, so to speak, those volatility hedges kicked in, we think, for dealers. And that allowed them to supply the market with more liquidity because they go, look, yeah, the market's sliding down here, but now with the VIX breaching 35 or 40, we're making so much with our tail hedges, or we're protected in that case. Then we don't necessarily need to short futures anymore and drive the market lower. We can sort of like hang out here because we have these volatility hedges on. So from a positioning standpoint, we're comfortable, we're maxed out. We don't need to sort of continuously pressure that market lower.
Yeah, that's great. That's really good dynamics there.
And you can see, I think a lot of times that same thing will happen in the upside in a lot of these stocks that are gamma squeeze names, you know, like obviously the memes of the world, but in a Tesla and similar things like that. I mean, the market makers, they'll get caught initially, maybe short, maybe they get a little surprised by something, but they can't accept being short convexity. So when you get Tesla breaching 1200 like it did, or CCJ or some of these uranium names or whatever it may be, right? You can watch the term structure sort of invert in these things, right? And basically what that's saying is that the price of options is getting so expensive that their payoff structure doesn't make sense anymore. And I think it's a lot of times dealers who are long those very expensive puts, right? And they're happy to let those puts get more expensive, but it starts to deter the market from wanting to trade those, right? You don't want to buy a put if the vol of that put is 200 and you need an 8 or 10% move for it to pay off. You don't want to buy a Tesla call that's a $1,000 call, right, at a 1200 strike, because it'll never pay off, or the likelihood of that paying off is very small. So that's why you watch the implied volatility and you watch how these, you estimate, hey, this is how the market is positioned. Even though I think like right now, the market is going to go lower. This is the path dependency of there's some puts decaying in the next couple of days here. There's the holiday, the forces that be may sort of lead to a little bit of a bid to eat some of that downside pressure. And then you can maybe drift lower into next week.
Definitely. So you guys, also over at SpotGamma, you have this new thing you launched, the HIRO Indicator, correct? And tell us a little bit about that, because I'm not very familiar with it. I know it's it's more to judge the real-time hedging impacts like intraday.
Yeah, thanks for mentioning that. So most of what we've done historically at SpotGamma is write a daily research piece, right? Looking on how options market's structured, and we say, okay, here's support and resistance levels, and so you guys have some of the options information to overlay that into your trading strategy. What we launched now is this tool called HIRO, and what that does is it looks at all the options trades that are taking place in real time, and it looks at what the delta hedging impact is of those trades. So we're trying to figure out how much hedging will dealers have to do based on everything that's taking place. So this looks at the SPX, the SPY, the Qs, and then it looks at around 125 other of the largest stocks in terms of options volume. So your Apples, Teslas, AMCs, GameStops, and obviously a whole variety of others. And the idea there is that you can see when call buyers come into the market, because the delta hedging exposure of the dealers, or that we estimate, which is the actual HIRO signal itself, starts to rise, right? We can tell, okay, look, traders are selling puts or they're buying calls here. And how might I want to address that, right? If I'm riding a rally, a call-driven rally in a stock like Tesla, you can see when those calls start to come out of the market, when the call flow shuts off, that the stock will often mean revert. I'll give you another example. This morning, with the spiders running into about 445 or 446, we saw spider call selling really come out into the market. And we believe that leads dealers to need to then short the stock. If nothing else, there's a sentiment indicator, and they're telling us, look, people are fading this move higher. And many of you great traders like Sam will watch price action and glean a lot of information from that. And this HIRO indicator is sort of like the price action of the options market. You can think about it. And so this is the first time that we know of that there's sort of been this angle offered in the market, right? What is the options market actually telling us, and how can I identify when the options are driving a certain stock? Because it's obviously not in every stock all day long that options are driving things, but there are key moments in times where maybe some cool meme gets posted on Wall Street Bets, right? And suddenly some stock is taken off, or you think some news broke in whatever GameStop, right? But you can't figure it out. But then you look on the HIRO signal, you say, oh no, it's just a whole bunch of people buying calls, and that's why the price is driving. And then I can react to that a little differently, right? And if you're interested in trying that out, it's a free 7-day trial at spotgamma.com. All of our subscriptions are free 7-day trials. Try it out. If you don't like it, cancel. No harm, no foul, right? We don't want to lock anyone into anything that's not useful for them.
Yeah, that sounds like a really good tool to me personally. Just, that's that extra validation in the move too, besides price action and understanding, when you can just see that indicator spitting out, hey, this move is getting, aggressive call buying, or now they're selling, like this morning, selling calls into that move. It's just such an A+ short setup there for, a rejection.
Yeah, and it was useful a few times around some different earnings announcements as well. Like Netflix was one that we chronicled kind of on the page, and Netflix had like a 20% drop over its previous earnings, and I know earnings are coming up again. And what you can see is that people started to monetize puts, and that really led to like, okay, this is a bottom in the market, because you could see people were starting to sell all their put options. So like, look, we're capturing this 20% downside. And then what was funny is PayPal and Facebook had similar drops shortly after that. Both were down around 20% plus, and the flow in those names was actually selling calls, and that was interesting flow because the volatility in that case was so high that traders selling calls, it's a volatility trade, right? And it wasn't a fundamental trade of people think, okay, Netflix, I got my short off. In this case, we could see call sellers coming into the market, and that kind of linked to us. Okay, look, this must be vol guys, right? Volatility guys who are selling calls. Maybe they're shorting the stock or buying the stock, whatever they may be doing. But we could tell different players kind of came into the market. And consequently, you didn't see a snapback rally at all in that Facebook and PayPal names. Meaning that comes, if anything, those big volatility sellers or traders kind of pin the stock down at those lower at those lower, marks. So with earnings kind of coming up, there's always these different ways of trying to play these earnings names, so to speak. And it kind of can almost help you sometimes identify, all right, who's trading here, who's really kind of controlling the flow in this name. How is the flow coming in and out? If you understand how the market, what the market expectations are and how flow is playing out, obviously you can gain some edge, I think. That's arguably what you have to have, right, to gain an edge in trading.
Yeah, right? I think there's huge edge in understanding that and knowing that. I mean, it even helps you position, the structure of your trade as well. If I were to see that, if I wasn't aware of that at the time, that it was, the big guys coming in and selling vol, I just, constantly saw this stuff, like with Facebook, for example, and PayPal, these things just constantly getting hammered. I was completely unaware that there was actually vol guys, that they were selling, doing more of this call selling. Because to be honest, when you get extreme volatility in some of these single equity names, for me as an equity trader, it's a little harder to come in and step on some size shorting Facebook when there's these, short cover rallies that, it rips back, 5 points here. But, if there the vol play was there, that's an interesting trade structure to just, go in and kind of sell those out of the money calls and sell that higher volatility call. And if you need to, you can essentially hedge it by buying the stock if the vol was overpriced. So I think it's an interesting tool there to give you a little, a different weapon in your arsenal to use for trading, different vehicle to trade with.
Yeah, and obviously, Twitter, we saw that where the vol spiked really high as well, and it was interesting to watch the action in there in the same vein, and knowing who or how to play a lot of these names, I think, is really what's separating sort of the mild retail players from the successful traders like you guys have here, is that you get now, because of meme mania and just the use of options, I think in general, you get these setups that are somewhat asymmetric, right? I bring up Twitter because the interesting trade arguably there was selling put options, right? Because vol had gone so high, the stock was crashing up for a couple of days, and you didn't want to buy call options there because you're just going to get stung real bad, right? But if the market or Twitter, the stock mean reverted, implied vol would come down, and that could actually make you money being short put, which is obviously counterintuitive to the way a lot of people think. And that was the best trade to do through the AMC and GameStop, the biggest days there, because the vol was so high, implied vol, that if the stocks went down, the implied volatility actually go down because there's, again, so much call demand. So identifying those situations. I mean, if you just think about it, if a stock is crashing, why would you want to sell calls? I mean, intuitively, you think you're going to set up for a dead cat bounce and could kind of rip your face off, right? But if vol is that high, you go like, who's actually going to be selling calls in this size? It's probably not, it's probably no dummy, right? There's probably And I think a lot of times too, it's the same thing now that works in the puts, right? The implied vol just goes so expensive. As you guys know, like, you don't want to short a stock in the hole, right? It's the same thing with vol. When the vol gets that high, and you can identify when the other players are starting to change their position and sell those puts or move out of these situations, it can be that extra little trigger. It says, okay, there's the big money there. That's what they're doing. So that makes sense, and I can adjust my sort of plan accordingly.
And I think that's really good, especially for, some of the newer traders that we have in here that, some of them, are still trading, mainly just strictly trading options because, capital requirements on the equity side. But I think it's very important, like Brent just said, to understand, volatility when you're trading options, because you have to understand the product you're trading. And like he just, like he said there, like we've told you guys before, when volatility is high in these names, there's not necessarily a trade there, even if it does move in your direction.
Yeah, and it's very, there's this thing called the rule of 16, which would probably be very helpful. And what that is if you look at the implied volatility, if you just bring up your broker's platform, you can look at any of the options. And if you divide that implied volatility number by 16, that tells you what the options market thinks is the volatility for the next day of that particular stock. So even if you don't trade options, using the information embedded in the options market can be very helpful. So for example, if you just divide, the VIX here at 23, divide that by 16, and that tells you what the S&P options market is pricing in for today's volatility, right? And exactly right. So, I think that unfortunately, fortunately or unfortunately, depending on who you are, they're only going to add more options, expirations now, right? The exchanges, they're adding more strikes all the time. It's becoming more of an important complex, right? And you can say, look, I'm just an equity trader. You don't have to express your trades and options, but I think you need to understand the flows, the way that calls and puts come into and out of the market to be an effective stock trader. So, even if you don't want to structure a call fly to play a name or sell put spreads or whatever it is, understanding how the puts and calls and things like that are pressuring or impacting the stock you're trading is I think, pretty vital these days.
I think it is too. Yeah. Well, that's been, I think, the biggest, a huge change. I mean, probably in the past, maybe a little longer than the past 2 years. It's in essence, you've heard everyone say this before. It's now the tail wagging the dog. The options market is driving a lot of price action, whether, in the S&Ps or even in these single names. It really is an edge that you need to understand.
Yeah, and that volume is, it's grown quite a bit. And like I said, I mean, you can, I don't know how many of you have heard this sort of spiel from me before, but if you look at the three biggest lows in the S&P 500, the S&P 500 is the biggest, equity index in the world. There's several $1 trillion in assets tied to it, right? If you look at the three biggest lows over the last, say, 3 years, it's December of 2018, you had March of 2020, and then we arguably had another big low here just in this past March. Those lows, yeah, I mean, January is like a big low as well. Those lows are all the day after options expiration. So you get the options expiration occurs generally on a Friday, and the Monday following that, if you look that up, it's Christmas Eve. There's this famous phone call, right? Mnuchin called the banks and all these things. Well, that Christmas Eve day in 2018, December 2018, was the day after options expiration. That year-end options expiration is massive. Same thing with the Corona crash, right? The pandemic crash. March 16th, I believe it was the Monday. That was the day the low was put in, and that market rallied 40% basically straight off of that. This January, past January, we put out tons of notes about this, about all these deep in the money calls that were expiring, and we had an interim January low, and then obviously this kind of famous low now of 2 weeks ago. So those are all when big put positions expire. So even if you're just the type of person that likes to allocate, capital slowly over time, and you say, well, I don't day trade, so I don't care. If you know when these big positions are lined up, you can adjust your allocation, right? Or say, look, I've been looking for an opportunity to get long and hold along for a couple of weeks here as opposed to day trading, right? Well, if you know this options expiration is coming up and there's tons of puts, the timing is critical there, right? And so those are just some basic examples of understanding how the options market can impact equities.
Definitely, 100%. So do we want to get into some questions? Do any of you guys have any questions here for Brett?
Yeah, I just have a quick question, I guess, while our guys are thinking. More of like kind of a macro opinion. Do you think that there's any chance the Fed could have a soft landing here? Or are they too far kind of behind the curve to catch up and kind of save this market from a pretty deep collapse?
Yeah, I mean, it's a great question, and I think the tough part is there's obviously inflation and now kind of being politicized, which a lot of that obviously they call it Putin's price increases and things like that, and a lot of those price increases are structural issues, right? When you look at oil and energy and the supplies of different core goods here in the United States. So there's the political issue of inflation and what that's doing to consumers. And so nobody knows what that outcome is. Obviously, there was the CPI print today that everyone got pretty excited about, and that caused a 60-handle rally in the market that faded. And so no one knows how the Fed is going to be able to react to that. They do 50 basis point hike. They have to do 100 basis point hike. Who really knows? So they're going to try to combat that. And Sam and I were talking about this before the call, that generally what the Fed does, you can look this up, is literally what they say is they move until something breaks. And then when it breaks, they go, okay, it's time for us to back off. Well, I would just point out mortgage rates, right? If you look at the average house, it's around $400,000 here in the United States, and rates just a few months ago were around 3% roughly. They're now up over 5%, talking about the 30-year, and that's effectively a doubling of the price of the mortgage, right? So you have all-time high housing prices with now significantly higher mortgage rates. You now have gas and all these other inflation related items that are getting much more costly, and so they're going to keep raising rates until essentially the economy falls apart, at which point they're going to back the rates off. So there's no clean and easy way out of this, and I think that ultimately, if you look at what the biggest political issue is right now, the number one problem people have, it's not COVID, it's not, geopolitics or anything else, it's inflation. That's what most people are most worried about. So you have midterms coming up. Inflation is the number one issue for politicians, and they're going to stamp that inflation out. I think even if it means the equity market goes down, good 30%, it's about fighting inflation, to keep most of America alive. I mean, unfortunately, I think most people have $400 in their pocket or something like that. It's kind of a dire situation financially for a lot of people, and that's the biggest segment of the population in terms of votes, right? Not that many people own stocks or houses, and is the reality. So basically, I think it's going to be move rates until something breaks, and then when it breaks, maybe you want to buy that dip.
Yeah. Super insightful. Yeah, we got some guys in the chat that are actually already SpotGamma subscribers.
Cool.
One of them, Santiago, has a question. They use your levels, pretty much every day. Yeah. So what do you feel has more weight for dealers, a combo strike or a large gamma strike?
Yeah, you put stroke in there. I don't know. Stroke sounds a little scary. Stay away from that. But thank you for the question. So I like the combo strikes in general. And the reason is because what that is looking at is all the gamma in the spiders as well as the SPX. And then it matches those up and figures out what's the largest. So if you look at our levels, we have L1, L2, L3, and all L1, L2 that stands for level 1, which is the biggest, down to 5. So in general, if you look at those combo strikes, the spiders can be, particularly on shorter term expirations, the spiders actually can have as much or more gamma associated with it than the SPX itself. So the combo looks at the whole S&P 500 complex really as a whole. I mean, 440 in spiders is this big level in spiders, and that's where we closed, I believe, yesterday, right? And I think that is kind of keeping the market, a bottom in the market here for today and in the next couple of days. So I'm going to go combo strikes.
Kind of where we're holding off right now as well.
Yeah, and again,
as you've been talking, the market's just been kind of drifting lower, and we just kind of cracked that 440 level and just reclaimed it and just kind of holding right above it now.
Yeah, and if you look at the setup now, there's a bunch of interest up at 4,500 or 450, and then in spiders there's a decent amount of 440, and then it's just kind of like it's a void really in between that. And our general model says that you want to be long equities when we have what's called a positive gamma market. And a positive gamma market simply means that market makers are hedging in a way that supports the market as opposed to hedging in a way that sort of expands volatility. So when you're under 4,500, the market makers are going to be selling futures as the market goes down. They're going to be buying them as the market goes back, and you have this whipsaw.
So essentially, they're taking liquidity in the negative gamma and providing more liquidity in a positive gamma.
That's a perfect way to put it. And more liquidity generally means higher prices.
Yeah.
And in this week we also got the holiday shortened week in general. We have this inflation print. I never know if these things actually mean anything. I mean, everyone's watching it and they react how they react, and it is what it is. But we had just this void, right? We're just flopping around kind of in this void, and the one flow from an options perspective that starts to kick in and it gets larger or more important as we move to Thursday afternoon is all these puts are decaying, right? There's a fair amount of puts that are decaying in the S&P 500 and in the NASDAQ as well. Again, it's nowhere near March, but as many of you know, if you buy a Thursday put and the market just does nothing, slowly that put's going to start to decay until we get to Thursday where it goes basically to zero. And if the dealers are short a lot of these puts, well, as we get into Thursday, those puts are going to erode in value, and that might keep a little bit of a lower bound here in the market.
Awesome. Cool. Well, it doesn't look like we have any other questions in the chat.
That's right.
So
Answered everyone's questions before they asked them.
Yeah, exactly. Yeah, unless there is questions, guys, feel free to throw them in there. Otherwise, just a quick note. We're super excited to kind of form this partnership with SpotGamma. We do have a link that we're offering only to Zeal Trading members, and it gives you 50% off your first month. There's of course no, required commitment after that. So it might be a good way for you to kind of figure out if SpotGamma is a good tool to kind of add to your arsenal. We'll send the link out after this to everyone. But if there's no other questions, guys, yeah. Sorry, just reading some notes here. If there's no other questions, then we can go ahead and wrap this up. Brent, super nice to meet you and talk to you, hear your insights. We really appreciate your time. Yeah, we'll definitely, we look forward to kind of continuing this partnership together.
Yeah, I do too. I think it's great what you guys are doing over there at Zeal, and the fundamentals of trading, make sure you're solid on those is important, kind of regardless of again, technical or fundamental or whatever it is you're doing. You take all these tools, but you got to know how to implement them, right? So kudos to you guys for training people how to do that. Definitely.
Thanks, Brent. We really appreciate you taking the time and doing this with us.
Absolutely. And anyone has questions, I'm on Twitter. I'm at SpotGamma on Twitter. You can leave comments on our YouTube videos, whatever it is. We try to help people and answer questions. And so feel free to reach on out.
Awesome. Thanks, man. We really appreciate it.
Thank you guys for the opportunity.
Thank you.
All right, guys. Have a great day.
Yeah.